Hello traders, hope you guys doing well and welcome to this special market update. My name is Alejandro Zambrano and I'm the Global Chief Market Strategist with ATFX. In this special presentation we're going to talk about the ISM indicator. It's going to be published on July 1st, so that will be next Monday, and it's an important indicator that a lot of traders and investors and analysts pay attention to. Now, why should we be paying attention to the ISM indicator? Well, because it has a high correlation with US GDP growth, and the indicator itself has been declining lately, and there are various reasons, but I think one of the main reasons, of course, is high interest rates by the Federal Reserve, and then, of course, as you know, because of the trade wars between US and China. So the number is out and will be out next week, and the last reading was at 52.1 for the manufacturing sector. Now this has still a bit further to go until it reaches that 50 line. At that 50 line, it tells us that the manufacturing economy is at break even. So if the number would go below that, that would indicate that the manufacturing sector is contracting. Now, because the manufacturing sector is not the only sector of the US economy, it tends to, that means really that the indicator itself would need to decline to 42.9 before it would imply that the US economy is in recession. So we're still far away from there according to this indicator. However, there's a better indicator lately that is less volatile, and that is the market US PMI figure. And that was published on last Friday. Now that indicator has been dropping very sharply lately, and you can clearly see here on this chart the correlation between the indicator and then you got the blue bars or blue histogram in the background, which is annualized quarterly GDP change. Now you can see here how the line has declined, and that does imply lower GDP figures going forward. And at the current reading at 50.1, it sort of tells us that the economy in general is sort of pretty much at break even to some extent, or the indicator is at break even, because trade below 50 and then you're sort of in trouble. And right now, the current reading, it does imply a growth of 1.4% annualized. So not really sort of in a major crisis, the US economy just yet, but on its way to reach those sort of levels. And the market doesn't necessarily pay attention too much to the market PMI, but maybe with the ISM numbers out next week, they might pay more attention to this sort of leading economic data. There's also other indicators that have been published recently. This is the New York Empire Manufacturing Index. As you can see here, it's turned negative, and that sort of hints a little bit that we should see further weakness. Now, what does this mean for the markets then? Well, I would say that for the markets, we'll probably see, further dollar weakness if the numbers on Monday next week print out weak. In fact, I still think they're gonna print out weak, especially given the market PMI numbers published on Friday, and this could potentially lead to a weaker dollar. So this is just your daily chart in your dollar yen, and the market, as you know, has been sort of trading sideways and slightly bullish about 107.75. And as I mentioned here, when we're trading here, it's that either people are going to short up here or they're going to short on a break to the downside. So we clearly saw that break on the downside like that. The market is not correcting upwards, but I think, already really on Friday, the market rejected that move. And since then, the price, is traded slightly lower. If we go up to 107.75, 108 again, I still think people are going to try to short sell here. And I think as long as we're below 108.70, there's no real reason to change the bias here. And another market that could potentially gain on lower economic data from the US are gold prices. So gold prices is something we've been watching for many years actually. But this pattern specifically here that we're referring to, we've been looking at that for quite some time. So there's different interpretation, and this is a weekly chart. You have the head and shoulders pattern with the head, left shoulder, and then the right shoulder. That gives you quite a significant potential rally here. It really suggests the market can rally up with $325 on the break. So that would give us a target of 1,700. Then you have this section here, which is just an ascending triangle, and that is the difference between this level and this level here is 218 pips, or $218 per contract. Now here as well, this market has rallied, and it still can trade substantially higher, About 1,600 is the target for that market, and this is just your weekly chart. And in the short term, you know, it's a bit overbought, and if you didn't already buy here on 13.74, fortunately you're too late. I think the best sort of action here, if you really want to get involved, is to wait for some sort of pullback. Not sure that's going to happen just now, but if we would have, say, a corrective move to something like 13.84, 13.74, I think people will be kind of keen on buying here. And I think if you want to trade and sort of try to target these longer term levels, like 1,600, and then you probably need the stop loss just below the weekly low, which is actually over here at pretty much 13.31. But in general, I think sort of a pullback to something like 13.80, 13.74 is probably going to be met by buyers, and I think that's sort of what we should be looking at for now. Of course, we can always be wrong, and that's why we always need to make sure that we don't risk too much money when trading. In general, I try to risk about 1.5% of my money, but then my average loss is usually about 1%. At the same time, I like to sort of try to get out, and I usually get out about 2 times my average loss, and that ensures that even if I'm not always right, which mathematically you're not when you're trading with a trend following system, because your stop loss is usually closer to your take profit, then you sort of, the benefit of a positive risk reward ratio really is that you don't have to be right all the time. And the setup in gold and also in dollar yen pretty much provides this. Okay, if you guys have any questions, as always, don't forget to reach out to me. Thank you so much for watching, and don't forget to subscribe. Thank you.